My name is Alesh Eisner, and this is going to be the Investing in Personal Finance Basics. This is going to be over 3 sessions. It's basically a course. I did receive, I hope you guys can see this, I did receive a grant for the Zoom license and a few other things from the Vancouver Foundation and the Neighborhood Small Grants. So anybody who thinks that they have something that would benefit the community in which they live, this is for Vancouver and Surrey. But if you believe you have something that would benefit your community, you can approach them, and they do have money available for those kinds of endeavors. So let's get going. So my name is Alesh Eisner. Just put an H on the end for the pronunciation. So this is we're going to try to do 5 of the lessons, 5 of the seminars. The first one is an introduction and just kind of course goals and that kind of thing. So introduction, this is going to be a basic investing. We're not going to get into individual stock analysis. We're going to talk about the different vehicles you can use to invest and to make your money grow. It's not going to be advanced. Okay, I do have another course that is about advanced stock analysis, but this isn't it. It got put together over a long while with various things that I wish I had been taught in high school. I'm going to give you a little bit of my background real quick, just why am I doing this and where I am. And we're going to go through the contents of the course that we're going to cover over the 3 sessions and what the course goals are, and then some disclaimers. I am not a financial advisor. I am neither licensed nor insured for financial advice. And of course, I don't know you, so I don't know your particular situation to be giving you financial advice at all. And then contact info. So introduction. So this course was born of more than 8 years of me doing lunch and learns for coworkers and basically adding to it. It started out as a single lunch and learn, and now it's sort of gotten 5 times the size. I kept slowly adding to it, so it went from 1 hour to 2 hours, and now it's definitely over 4. It contains information to get you started for investing. Let me move this. And hopefully to have you avoid the pitfalls. And it's for those people who don't really have very much information at this point. For those of you who are investing, maybe it'll tie a few things together for you. Maybe it'll give you some context for information that you already know. Or maybe just organize things a little bit better for you. So we'll see how it goes. I'm definitely hoping to give you a couple of nuggets. In the next session, we'll be talking about taxes a lot, which I think is something where people maybe don't have as much information. So definitely come back on Thursday for that. Okay. So seminar 1 is the introduction. That's where we are now. Seminar 2 is going to be the glossary and building blocks, so the different types of assets. Seminar 3 is quite an important one, which maybe people know sort of inherently, but haven't really gotten it in an organized manner. So risk and volatility. Seminar 4 is encouraging the 20-year-olds among you to start early and start often, and the importance of low fees. Seminar 5 is some investing strategies, so we'll go through some basic things. Seminar 6 is taxes, so that's, I think, where we should start Thursday session, the next session. Seminar 7 is going to be personal finance, various topics. Seminar 8 is going to be insurance. And seminar 9, I think, is going to be the start of the 3rd session, depending on how things go. And we're going to talk about financial independence, which I think is a lot of people's goal. And seminar 10, very basic, how to start investing. Some people don't know how to set up a brokerage account and how to buy an exchange traded fund, a mutual fund, or a stock. So I'll show you some screenshots from my brokerage, which of course means if you have a different brokerage, it'll be different. Seminar 11 is other types of investments. So we'll cover things like real estates and private equity. I like that particular lesson because I compare and contrast different types of investments. So I think it sort of ties things together for you and lets you determine what kind of investor you are. So that's all in the third session. And then we have seminar 12, where we talk about financial advisors, what you should expect from them, and unfortunately, what you usually get, and other information. So, course goals, discuss basics of investing in personal finance, cover simple investing strategies, compare different vehicles and account types, and talk about taxation. Because if you're going to be investing for the next 20 years, make sure that you're doing it in the right accounts. So this is for us Canadians, tax-free savings account versus registered retirement savings accounts, and so on. So look at becoming financial independent and saving for retirement. That's I think most people's goal. Uh, Financial independence means that you no longer have to work. Retirement obviously also means that you don't have to work, but it usually happens in your 60s. And for those of you who want to do it earlier, investing has definitely been what has gotten me to financial independence. So I'm trying to share that with you. What you should walk away with, how to begin investing, knowing some of the basics, obviously. 3 sessions are not going to get you ready for Wall Street or for Bay Street. So this is a basic course. You should be motivated to start investing and to educate yourself further by becoming interested. So, this may not be the most fascinating thing in the world. I get that. What I would suggest is from these seminars that you see that it's important to start investing and to get educated and to keep going beyond these seminars by I mean, there's so much information out there. Most of it is good, some of it maybe not so much. But that's sort of my main goal, is to light a fire under you. So as we're covering the different ways of investing in the different asset types, start thinking about what you would like to invest in. So this is going to determine your method, including whether you want to use a financial advisor, whether you want to do it yourself with a discount brokerage, and which brokerage you want to use. Generally, you want to pay as little in fees as possible for whatever your chosen strategy is. So we'll get into that, but just kind of keep that in mind as we're going through this. Think I'm this type of investor, or I think I'm this type of investor. So yeah, do you want to do it yourself or use a financial advisor? And I do believe that 95% of people can do it themselves after doing some reading and learning a little bit. Showing that interest in doing it. If you want to use a financial advisor, perfect. We'll cover what you should be expecting from a financial advisor, as I had mentioned in the third session. So do you want to do it yourself? And if so, do you want to use stocks? Do you want to use exchange traded funds or mutual funds? So I'll cover what those are in a little while. Do you want to use an RSP account? Do you want to use a TFSA account? Do you want to use others? Do you want to do small monthly purchases, or would you prefer to do, $5,000, $10,000 lump sum instead? So kind of start formulating that in your mind as we're going through. So keep in mind here that I am talking about long-term investing. None of this is going to be a get-rich-quick strategy. In fact, I'm going to kind of speak against it as we go. So if you want to be a millionaire in the next 6 months, unless you're making 800,000 a year. I don't think that's going to happen as a result of this course. So uh, just keep that in mind. Okay, disclaimers. This is an investment advice. It's for educational and demonstration purposes only, nor is it a solicitation to buy or sell any securities. Contact information on YouTube. You can find me Canadian Money Talk, on TikTok, where perhaps quite a few of you met me. Canadian Money Talk is my TikTok website. You can see in the bottom right corner as well, CanadianMoneyTalk.ca. And you can reach me on this email, which you can also find on my website. So that's kind of the introduction. Oh yeah, so my background. Let's do that. I kind of skipped that part. So really quickly, I worked in IT. I was not particularly enjoying my job and became very motivated to uh, have a way out. So the financial independence means you don't have to work anymore. Uh, there is a wonderful acronym out there called FIRE, which stands for Financial Independence, Retire Early. I don't think most people actually want to retire early. Like if you're in your 30s and you don't have anything to do, that's bad. So I just wanted the FI part. And so after one particularly bad job, I became very motivated. I learned and I started investing with mixed results. Then I started contracting instead of working permanent and became incorporated. And I was able to save significant amounts of money. I concentrated on investments that had some sort of a cash flow that gave me monthly or quarterly dividends or interest or something like that. And eventually I got to a critical mass of my portfolio where I basically can live comfortably without working ever again. So just to keep myself entertained, I started doing the YouTube and the TikTok, and here we are. I haven't worked in a significant way in the last 4 years, and uh, I could have done it earlier as well. It's just I never knew when enough was enough. So I kept working until I had to quit, and my portfolio was there to support me. So that's sort of my background. I'm happy to pass this on uh, to everybody else, and hopefully you'll have the same freedom that I do. So we covered the contents, course goals, and the disclaimers. Okay, so seminar 2 is the glossary and building blocks. So when I say building blocks, this is what the underlying investments are for your portfolio. But investing, just like a lot of jobs, have their own particular vocabulary where there's acronyms and words that are not used by regular people who are not in that job. And so just so we all understand each other, I went through and created a glossary that I think it's important for you uh, to know what these words mean while we're talking. So this is going to be some definitions, some jargon, and basically a glossary. We are going to compare and contrast stocks, exchange traded funds, and mutual funds. So first thing is stocks, shares, or equity. So this is always going to be, can I? Okay, maybe that'll be better. This is ownership in a company. You basically get a slice of a company. It may pay a dividend, meaning it gives you a percentage of its profit and it just plunks it into your account, or it may not. So that's stocks. It means ownership. A bond, on the other hand, is a loan. You expect to get the money that you loaned back. You could loan money to a government, so government bonds, and you could also lend money to a company if they don't want to put out more shares, they don't want to lose control by giving investors ownership, they will instead get put out a loan. And bonds pay interest. Okay, so that's the key difference, is that a bond is a loan. We've heard of term deposits or guaranteed investment certificates. This is when you go to the bank and they lock up your money for 6 months, a year, all the way up to 5 years usually. It should be insured by the government and be safe. So there is no risk, but the return is relatively low over the long run. These days we have GICs that are around 3, 4, maybe even 5% in the US. That's because interest rates are high. That's fairly uncommon, but they are considered to be safe. Asset allocation, a really long phrase which financial advisors like to use and people don't know what it means. It just means how a portfolio is divided between the different assets. So how much of your portfolio is in stocks, how much of it is in bonds, and how much of it is in other assets. This actually happens to be the most important factor in how much your portfolio is giving you, returning to you. So stocks over the long run will outperform. Bonds are safer and they perform a little bit worse. So it just depends on what you want from your portfolio, is how you allocate your assets. Okay, so I hope that's clear. And by the way, so I am looking at the meeting chat. I see hi from Deborah. If anybody has any questions, please do type them in. Looks like the chat works at least. And let me know before we go much further if you have a question about anything. Next, we have an index. I'm going to use index and benchmark interchangeably. And basically, it's a representation of a stock exchange. So you'll hear S&P 500, which stands for Standard & Poor's 500. That's an index for the US, for the New York Stock Exchange. TSX is an index for the Toronto Stock Exchange. So when the reporter says the TSX was down today, they were talking about the TSX index. Hello, Grant. It's used as a benchmark for other vehicles. It can be used to represent the market. So if I have a mutual fund that is full of US stocks, I would be using the S&P 500 as a benchmark to see if my mutual fund is outperforming a formula, basically, because the S&P 500 is just a formula. There's literally hundreds, if not thousands, of other indexes. S&P 500 is a very famous one, and obviously for us Canadians, we got the TSX. So mutual fund. This is likely what you were sold when you went to your financial institution and you got a financial advisor. It's a basket of investments. You got stocks, bonds, real estate, gold, cash, depending on the mutual fund. So you need to choose the right mutual funds in order to have whatever you want to be investing in. Mutual funds can hold pretty much anything. So now a balanced mutual fund, by definition, the word balanced means that it includes both stocks and bonds. It could be a 60-40 where it has 60% stock and 40% bonds, 70-30, 80-20, whatever it is. As I said earlier, bonds tend to be a little bit safer, but also won't have as much of a kick upwards as stocks. So if you have balance, then that means you're going a little bit safer. So you won't have as much up and down in your investment. but over the long run, you're probably giving up some returns. Okay, exchange traded fund, which I'm gonna call ETF from here on out. Same kind of an idea as a mutual fund. It's a basket of investments. It trades a little bit differently than a mutual fund. And as you'll see a little bit later, a good number of them just follow an index. They just follow a formula. Now, something you'll hear about is the management expense ratio, or a MER. And this is a percentage of assets that the owner pays to the ETF or the mutual fund company that's administering that investment for you. You never see the MER be deducted, like it won't show up on your statement or anything. It'll just come off and it'll lower the mutual fund price or the ETF price. That's how the company that's running that investment keeps the lights on and makes a profit. This is usually what we talk about when we say fees, is this annual management expense ratio. So actively managed will refer to a mutual fund or an ETF. And actively managed means that a human is making decisions about what assets to include in that basket of assets. Okay. Um, Passively managed means that the assets are mechanically chosen by some sort of a formula. So it could be following an index. It could be stocks in a given sector. So you could have an passive ETF that follows the energy sector and or consumer staples or technology or what have you. So it'll just follow some sort of a formula. As an example, it could be company has to be at least this big and it must have made a profit in the last 2 quarters. So that's what determines whether a company is in that passively managed, usually ETF. So correction is something that the stock market does when it's down 10% from a recent top, from a recent high. Corrections happen frequently. You could have once a year, twice a year without much of a problem. 10% is sometimes it's considered healthy, that you have a pullback in the market, and that allows the market to keep going up. So it's just really to be expected depending on the investments that you have. It's just part of investing. It's really nothing to be afraid of or to be avoided, because the markets generally recover fairly quickly, and I've got statistics for that later, from corrections. Now, a bear market is when you have a downtrending stock market. I kind of remember it by bear down. And that's when it's down 20% from a recent top. So that's a bit more serious. People start feeling that. And this happens on the average maybe once every 4 or 5 years. Uh, I consider it an opportunity to buy something that's cheap. Again, the markets do recover from this as well. It's not pleasant to watch your portfolio do that, but it is just part of investing. Bull market is an uptrending market, and the stock market enters a bull market when it's up more than 20% from a recent bottom. So back in 2020, when the market started dropping as a result of the pandemic, we had a bear market, a very quick one, and then the market recovered into a bull market all within the same year. That was exceptional with the quick recovery, but we sort of had a bear market and a bull market with moves of more than 20% in both directions. So recession is now referring to the economy. That's when the gross domestic product, which is a sum of all the services and goods produced in an economy in a country. A recession is when the GDP has decreased 2 quarters in a row. It's a little bit more uh, nuanced than that. There's an actual academic body that declares that we were in a recession. Uh, if employment is full and nobody's feeling any pain, it doesn't matter if the GDP has gone down 2 quarters in a row. Um, it's a technical recession, but not a real one, and it's not going to be declared a recession. But technically, 2 quarters in a row if you have negative 0.1 GDP growth. Depression, which we haven't had since the 1930s, is when the GDP's decreased more than 10%, or it's a recession that lasts more than 2 years. So that's a significant slowdown to the economy. The reason we haven't seen one since the 1930s is because the government and the central banks fiddle with the economy by using interest rates and uh, spending by the government in order to prop up the economy and kind of smooth out the ups and downs. So we definitely have recessions every so often. Depressions, fingers crossed, we won't have anymore. A brokerage, discount brokerage is a place usually online where you can transact stocks, bonds, and other types of assets. Uh, if you have a financial advisor, you don't have to deal with a brokerage. You just sign some forms and they do all the transacting for you. If you're doing it yourself, then you have a brokerage. I use three. I wouldn't recommend that. It's a little bit hard to get an overall picture, but I just use each one for whatever they're good at and charge me the least amount of fees. So that's a brokerage. So capitalization is the worth of a company measured using price per share times the number of shares that they have out. So what that looks like is market capitalization in dollars. So a mega cap is if it has over 200 billion. We have, I think, 3 or 4 companies, Amazon, Google, Microsoft, which are over a trillion in the share price times the number of shares that they have out. That's so mega cap is over 200 billion. Large cap is kind of 10 to 200. It also depends on who you ask. Mid cap is 2 to 10 billion. Small cap is kind of 300 million to 2 billion, and micro is 50 to 300 million. I know it still sounds like the company's worth a lot, but in the grand scheme of things, it's not. Um, so so when I say small cap or large cap, I'm basically talking about with small caps, you probably haven't heard of the company. Large cap, you probably have. Okay, so now we move on to the investing vehicle. So these are kind of our building blocks. So stock, this is underlying most of your mutual funds and most of your ETFs. For a beginner, I would not suggest to start with individual stocks, but let's go through this. So it's shares of ownership in a company. It has something called a ticker. So CPG, for example, is a Canadian oil company. Uh, they're bought and sold on a stock exchange during the day when the stock exchange is open. When you look at fees, there's usually commissions to buy and commissions to sell. There's certain brokerages which don't charge you any commission, so that's why I have a zero. Uh, most will charge something for the transaction. Uh, some will charge you less if you have a lot of assets with that brokerage or if you do frequent trading. Some will charge you by the transaction, some will charge you by the share. Okay. So like mine charges, I think 675, whether I do 5,000 or 500,000 purchase. So you got to find the right brokerage for what you want to do, as I had mentioned. So the pros of this is that there's no annual fees. Once you paid that trading commission, if any, you don't pay anything again. So I will buy stocks and I will hold them for a decade and counting. And so, I paid 675 and I hadn't paid anything since then. Uh, you don't pay any taxes unless you sell or unless they pay you dividends. So if you find a stock that doesn't pay any dividends, then you're in control of when you're going to pay taxes. You choose to pull the trigger on when to sell it. Otherwise, there's no taxes. So the cons of buying an individual stock is that it's not diversified. Depending on the brokerage, Canadians are usually limited just to US and Canadian stock exchanges. I use one of my brokerages is Interactive Brokers, where you can buy on any exchange around the world. Um, I don't particularly want to, but I could. As I said, don't start with individual stocks as a beginning investor. Just don't. There's a lot of analysis, a lot of keeping up to date, and you would need to buy several stocks in order to be even remotely diversified. So I wouldn't suggest that as a beginner. So then we have exchange traded fund, which quick reminder is a basket of various types of assets. You'll note that I specified passive here, and we're going to cover active right after this. So it still shares in a bucket of stocks or other assets. It also has a ticker. Uh, it's also bought on a stock exchange and sold on a stock exchange. For the passive, it will follow some sort of an index or a sector or own stocks with a certain characteristic. So for example, low price variability, dividend payers, dividend growers, it'll be something like that. Same kind of commission to buy as the stock. So one of my three brokerages is Wealthsimple, which have no commissions for buying or selling. So if that's the brokerage that you choose, you could be buying ETFs without any fees, so free. With ETFs, there is that management expense ratio, that annual, anywhere from a 20th% through to 0.4%. Some US ETFs, I think, actually have no MER at all. The pros of ETFs is that there is diversification with a small amount of money. The fees are relatively low, especially for these passive ones. It tends to be tax efficient. There's not much in transactions within the ETF. If there are ETFs and the ETF internally, without you selling anything, makes money internally, it has to, by law, pass that on to you. Passively managed ETFs generally have very low transactions, so there's not going to be much in tax consequences. If you have a brokerage that will charge you commissions per trade, you can usually find a list of ETFs that you can buy without a commission. So my brokerage that normally charges a commission has like 100 ETFs that you can buy without commission. So cons are that they are passively managed, so there's no human looking after it. So they could do poorly during down markets. Generally, that's not the case, interestingly enough. And keep in mind that they're not going to outperform the index. They're just going to match it because they're following it, minus the small fee. So they're always going to be a tiny bit underneath their benchmark, underneath their index. So that's a passively traded ETF. It trades during the day, so you can see the value of your ETFs go up and down during the day. Um, so now mutual fund is a different animal. They're, for the most part, they're actively managed. Still bucket of stocks or other assets. However, they don't trade during the day. They're usually bought and sold overnight, or always bought or sold overnight, using whatever the closing price was of all of their underlying stocks and other assets for the previous day. It has a code, usually 3 letters, 3 digits. It could be 3 letters, 4 digits, that kind of thing. So it'll be something like MAW 108. Because it is actively managed and you have a portfolio manager with research staff and so on, they will have a relatively high management expense ratio, depending on a mutual fund, 1 to 4%. And depending on how you bought that mutual fund, there could be penalties for early sale. There's something called a DSC, deferred sales charge, that's not allowed in, I think, anywhere in Canada anymore. But if you have an older mutual fund, you could have bought it under a deferred sales charge. And in that case, you have to hold it for 7 years usually. So benefits again are the diversification. There's a human making decisions. And generally, there's no commissions to buy or sell, but if you're doing it yourself through a brokerage, they've fairly recently started charging a trading commission even for mutual funds. But your financial advisor will generally not charge you a trading commission. Cons are the high fees, like I said, 1 to 4%, which is significantly higher than the ETFs. Uh, your financial advisor is hopefully adding some value to you, but they have a conflict of interest because they're making commissions off of what they sell you. They often underperform their indexes. So why is that happening? It could be bad stock selection, and it's also these high fees, which immediately puts them behind. So that's why ETFs came into being, where people said, well, why am I paying these fees just for you to underperform your index, your benchmark? Why don't I just buy the benchmark and call it a day? And that's why ETFs came into vogue 50 years ago, give or take. If there's a lot of trading inside the mutual fund, if the mutual fund manager does a lot of trading, the transactions may cause tax to you without you selling anything. So like I get a T-slip from my mutual funds where they're passing on capital gains to me, where the trading inside produced profit, and therefore I have to pay taxes without having sold anything. So that's something to be aware of. Um, and then we have a mutual fund, which is passive, where it just kind of follows an index. Really, same thing. The MERS are a little bit higher than the ETF would be. They should be tax efficient, and the no commissions is debatable these days on mutual funds. They are passively managed, and again, they just follow the index. Okay, I'm gonna pause here. Everybody's sort of clear on these different investing vehicles that we're going to be talking about for the majority of this session, and the next two as well. Anything? I'm gonna take a drink. Anything? Okay. Hopefully everything is clear. Okay, so that concludes seminar 2. Ron, this is great info. Pretty clear. Awesome. Okay, good. Thanks, Chris. Uh, okay, cool. All right. Uh, So we talked about the definitions, we talked about the jargon and the other unique words, which I'm hoping most of you have at least heard. Maybe now, maybe it's a little bit clearer now, or it's just reinforcing. We talked about stocks versus exchange traded funds versus mutual funds and the different flavors of mutual funds as well. So this is risk and volatility. So to me, this is an important one. You might sort of be doing it inherently, uh, but let's just kind of go through it. So risk, I'll make the joke that it's a four-letter word, but it just means ups and downs. So we'll go into that. We're going to see to get you thinking about your risk profile. And so risk profile is your ability to handle volatility. That's all it is, ups and downs. Risk, I know sounds bad, but it's actually not. It just means up and down movement. You know, is your investment, is your portfolio moving up in a fairly straight line, or does it look like a sine curve? A lot of ups and downs, peaks and valleys. So your ability to handle it will determine what sort of investments you want to be in. Okay. So let's kind of break it apart. There's basically five pieces to your risk profile. So risk tolerance, first of all, the ability to handle the ups and downs psychologically. Are you going to freak out when you see a statement with losses and then you can't sleep at night? Uh, I'm also going to say, especially beginners, but nobody truly knows their risk level until there's a down market. So back, in 2020, 2021, uh, you could invest money into anything and it went up because there was a lot of money around, interest rates were low, so people could borrow, people were bored, so they were learning about investing and they were putting money into the market, and it seemed like you couldn't lose. And so that was still volatility, but it was to the upside, which nobody ever complains about. Where people truly learned their risk tolerance is in 2022 when interest rates started going up and the free or cheap money was over. And now I talk to people, I do TikTok lives, and I talk to people, and they said that their portfolio was down 70%. So they were all on board while it was going up, but in 2022 it was just quite eye-opening. So don't think of yourself as risk friendly until you've had the odd dot-com crash like I did in 2002, 2008 when we had the real estate crash and the financial crisis. Same thing in 2018 and 2020, especially. Like you have to sort of either work with your financial advisor, or if you're doing it on your own, you have to be aware of this, and this will be a big indicator as far as what you want to be investing in. So that's risk tolerance. Risk capacity. So are you able to handle downturns financially? So are you selling assets that just dropped because you want to buy groceries? Do you have other sources of income to be able to handle downturns? And we'll talk about some strategies, I believe, in this session. So maybe risk capacity is a little bit easier to calculate than your psychological ability to handle downturns. But if you're going to need the money soon, then that is a major determinant as well in what types of investments you want. So for example, somebody says, I'm trying to do something with the down payment that I have for a house, or I'm trying to save up to go on a vacation, and I'm going to say, if it goes down, are you going to be okay? And if they need the money in 6 months, then I tell them you really need to be in term deposits, something safe that's going to maybe get you something, but um, yeah, you shouldn't. If you need the money soon, or you definitely need the money like to buy the groceries, then your risk capacity is lower. So financial education, just the more you know, will increase the amount of risk that you're able to stomach on the average, right? Somebody could take all the courses in the world and they still don't like their money going down because they think that they work way too hard for it. And in that case, that will put them into a different set of assets than somebody who's a lot more risk friendly. So your financial advisor will generally, when they first start working with you, they'll give you a KYC questionnaire. It's usually 20 questions, which will give them an indicator of uh, what you're sort of willing to take as far as risk in your portfolio. If you're doing it yourself without a financial advisor, then it's know yourself. Okay. So uh, your risk profile will play into that. The time frame when you need the money back, which I touched on, kind of all other things being equal, you should not be in stocks unless you have at least 5 years, preferably 10 years before you need the money back. If you're a 20-year-old and you want to be saving for early retirement when you're 40 and you have a 20-year time frame, you should be in stocks. But if you basically do not feel good with especially the downs, but like with the ups and downs, then that will probably change your investment types. So maybe instead of small companies, you would want to be in large companies instead, even if you had a 20-year time frame. Returns needed. So don't expose yourself to more risk than you need to. So if you have, I'm making this up, you have $100,000 and you say, well, in 10 years, I just need to have 150, then it's like, well, you just need 5% a year or even less with compounding. So you don't need to be in something super risky. But if if you say, I want to double my money in 5 years, then it's like, well, you're going to have to be in some small cap stocks, which will have a lot of volatility, and you could end up losing money over that 5 years as well. And if somebody says, here, I have $10 and I want to be a millionaire overnight, then I think you're either going to Vegas or buying a lottery ticket, right? Where the risk is extreme that you're going to walk away with nothing, but there's a small chance that you will fulfill your goal. So it's all a spectrum based on these things. So basically your risk profile, which is composed of your risk tolerance and your risk capacity, plus the time frame that you have and the return that you need, all together drives what portfolio you want to be getting yourself into. If you have a financial advisor, you get a nice sober second thought maybe, or they're just going to give you a predefined portfolio depending on how you answered the questions. So it all depends on where you are with your investing. So do note that stock markets do not only go up, you have to be ready for some down years. Bonds will usually smooth out your portfolio. They won't go up as much as stocks do over the long run, but they also won't go down as much. We had an exception in 2022 where bonds lost value because interest rates went up. So both stocks and bonds took a beating. So the bonds didn't provide the diversification and the safety that people were generally looking for. So that's an exception. Usually bonds are safer, but they're going to be a drag on the performance that stocks would otherwise have. Okay. So this is just something I pulled off the internet, but this is a relationship between the rate of return and the risk, the volatility. And this happens to be an American one, so low risk, low return is going to be basically stable assets where you have a little bit of real estate, you have stable principal assets, and then you have some commodities. And you sort of go up the spectrum. You start including stocks with the blue, international stocks, which are, I guess, all things being equal, are considered to be riskier than US stocks close to home. And so the highest return and the highest risk is going to be a bunch of US stocks and then a bunch of international stocks. So that's sort of your spectrum. You need to figure out where you are. This is an example. You can include or exclude whatever you want out of it, obviously. But that's sort of how that works. And risk and rate of return are correlated. The higher the risk, the higher the volatility, and over the long run, the higher the return. In the short run, with something that's super risky, all bets are off. Okay. So I think I stated some of these, but just to cover it. So stocks are generally more volatile than other assets, with a closer to home stocks thought to be less volatile. Okay. That's just how people think, closer to home, closer to rule of law, whatever. Doesn't have to be like that. But generally. So in that case, Canadian stocks are the safer compared to US stocks, followed by international stocks. This will be an increase in volatility. I mean, you could buy a small Canadian stock, which will have more volatility than a big European stock. Um, so larger companies and their stock are less volatile than small company stocks. So it's a combination of size and, let's say, geography. I mean, a company that trades in Britain or in Germany, I would say, is still quite under the rule of law, but if you buy something in Russia or Venezuela or something, then that's a different story. Bonds are generally less volatile than stocks. Again, that's a generalization. You could get um, some a bond put out by a company in a developing nation that is going to be riskier than if you buy a stock in Canada or the US. So in general, the more risk you're able and willing to accept, the more time you have and the more return you need, the more volatile your portfolio can and will have to be. So if if you need to hit a home run, you sort of need to be prepared to strike out as well. So that's sort of the concept here. So write down your life goals. Why are you investing, and what you want your portfolio to do to you, for you, or to you, I guess, but to do for you. This is your why. So as an example, I want cash flow for my portfolio. I don't want it to go to zero, but I don't need it to double once a year. I just need it to kick off some cash flow so I don't have to go back to work anymore. So you should have a goal for your portfolio, and that's sort of what you should always be comparing any investment that you are making or that you currently have. You should be comparing that. Is it furthering my goal? So I think I just said that. Check each investment and investing decision against your goals continuously. Uh, if you have mutual funds, it's probably a lot less work than if you have individual stocks, but always kind of say, is it doing what I want it to do? Volatility and return are correlated. I mentioned that. So if you need a large sum to meet your goals, you're going to have to stomach more ups and downs than if you needed just a small percentage and percentage returns. And if you need a super large return, then there's a risk that your portfolio could go to zero. So, I mean, there's lots of companies, just as an example, in Canada, we have a lot of junior miners that uh, are looking for whatever mineral or whatever it is that they're looking for. If they find it, they're going to go times 100 for share price. But if they never find it, then eventually they go bankrupt. So that's that's sort of the worst case scenario where you need not only to stomach ups and downs, but also risk that it'll go all the way to zero if you need super high returns. So the best investment, so this is fairly important, so make sure you know what I'm saying here. The best investment always has the highest return at each volatility level. So uh, don't just look for the highest volatility. At each volatility level, try to get the best investment. So super volatile, try to get the best return. If it's something super volatile, look for something that's going to have 100% expected return, not 80%. If you have something super safe, then pick something that's going to get you 5% and not 4.5. So that's what that means. Try to always maximize the return at a given volatility level. So I think this is going to repeat what I've said, but investments that return 30% a year will have huge volatility. So don't get into highest return investments unless you're okay with that volatility. Nothing goes up in a straight line except for term deposits, but then they go in a fairly flattish line. Their returns are low, and I'll show you that in a sec. Time frame is important because if you need the money back soon, you can't have the money in something that's risky. You could get unlucky and you need to pull the money out after a pullback, and then if you have no choice, then you've sort of locked in those losses. As I said, stocks need at least 5 years, preferably 10, and as the time nears, you want to be rotating out of stocks and into something safer. And as time approaches, when you need the money, you want to start de-risking the parts and the amounts of your portfolio that you're actually going to need. So you shouldn't need all of your retirement all at once because the retirement is going to run hopefully for 20 plus years. So even if you're saving for your child's education, even the tuition money is over 4 years for an RESP. So really just the vacation and the house down payment are all at once. So keep that in mind. You don't need to cash out everything when you on the day that you retire, right? You're hopefully going to live another 20 years and you should still have something that has some growth to it. So this is a quote by Paul Samuelson, who said, investing should be like watching paint dry or watching grass grow. If you want excitement, go to Las Vegas. So the reason I like this quote is because I'm more of a personally a stock investor, but I'm not into something that's crazy volatile. I don't need my portfolio to double in a year. So I don't need that excitement. In fact, I sort of avoid the volatility in my stock investments. Okay, so risks and types of investments. So this is a rule of thumb. So equities in your asset allocation, 100 less your age was what was used previously. 120 less your age is sort of what a more recent update is. You could think, and this is totally up to you, you could think of pensions as risk-free income. And when you're calculating how much money you need in retirement, you could look at pension as basically risk-free income and just subtract it out of the amount that you need in retirement. Just when you're doing your financial planning. Something that will handle risks and making those adjustments for you automatically is something called target date funds, where you buy a mutual fund, but in its name, it has a year. So 2050, 2051, 2052, there'll be a separate mutual fund for each year. And what it does is it'll make adjustments internally to the portfolio that target date fund holds. So So that way you won't have to fiddle with your portfolio, as I had suggested earlier. They'll do it for you. They will charge you a little bit of a higher MER though, but on the day that you need your money back, it's going to be in very safe investments when you need it. And if it's 20 years out, then it's going to be in volatile stocks. So that's how they work. So if you have significant equities, you should definitely have an emergency fund. You should have an emergency fund, I would argue, in most cases. This is so you don't have to sell equities to live on after they've gone down. So this is 3 to 6 months of basic expenses, depending on your type of job. If you have a spouse who works, etc. It's designed to cover unexpected but necessary expenses or bridge the temporary loss of income between jobs. Because I'm hoping your job is able to keep you uh, to keep you alive when you are working. So what you want to have the emergency fund for is when you get laid off after your severance and unemployment insurance wears off, then you still want to have an emergency fund so you don't have to sell stocks, which are volatile and could be down. They don't have to be, but they could be. Back in the 2008 financial crash, I knew people, couples that worked at the same bank. That's where they met. They both had most of their assets were of that bank's shares, and the banks took a beating and they both got laid off. So now they couldn't really sell the shares that they had in the bank because they came down, or they didn't want to sell them, and neither of them had a job. If one of them just had a job, then they wouldn't have had to sell anything, or if they had an emergency fund, they wouldn't have had to sell anything. Okay. So that's something to consider. I would argue have an emergency fund anyway. If you have a safe government job, maybe just have a month's worth. And this is more for emergencies, like if, your car needs repairs or what have you. If you have lumpy income, meaning you're a realtor or a contractor, and maybe you don't work for a while or don't have any income for a while, then have 12 months, whatever it is that makes you feel safe, but especially if you have equities. The other thing you could do is have an opportunity fund, where you have cash to buy more equities after they went down. I would suggest for these to be two separate buckets. The emergency fund, you'll need that to live on, and you don't want to be buying equities with your grocery money. I mean, I applaud you for being a hardcore investor, but you want to buy those groceries, so make sure you have a separate bucket of money to buy the equities after they've gone down. So they call it keeping some dry powder in the investing world, or an opportunity fund. So there's something called a bucket portfolio. Now, I think this is just to illustrate how different types of assets work. But if you're nearing retirement, or if you are retired, it is a way to organize your assets. Uh, Ideally, you start doing it a little bit earlier, because as you're moving stuff around, if it's in non-registered accounts, you may trigger taxation. So you might want to do it over 5 years to kind of get into this into this configuration. So the bucket portfolio, usually we just have 3 buckets. You can have more. Bucket 1 is 2 years of living expenses in cash. This is so you don't have to sell stocks after they've gone down. Most market downturns, I'll show you a little bit later, only last about 2 years, at the most, actually. So if your portfolio took a header, you're able to live off of bucket 1 without having to sell something after it's gone down. Bucket 2 is 8 years of living expenses in high quality bonds and dividend stocks. So this is stuff that maybe will go down, but won't go down significantly, and it'll kick off some cash flow, either as dividends or as interest from the bonds. So that would be bucket 2. So now we're 10 years, we're in pretty safe waters. And then bucket 3 is everything else. So if you have a net worth of 10 million, and you figured out that you want to live on 100,000 a year, 2 + 8 is 10, times 100,000 is a cool million. So you would have 200,000 in bucket 1, 800,000 in bucket 2, and then 9 million in bucket 3, because there are extremely very, very, very few times when the market had not recovered in 10 years. Therefore, for 10 years, you should be able to live off of bucket 1 and 2 while your bucket 3 recovers after like a horrible crash. The one exception is NASDAQ, which is a technology index, or sort of a technology index, and that took over 10 years to recover after the dot-com crash. That was like, if you had the worst timing ever, it would have taken a little bit over 10 years. Everything else recovers usually within the first 2. So bucket portfolio, and you can just Google it. Morningstar, which is a research website, which is my Bible. They talk about bucket portfolio a lot, and there's multiple articles that they've written. But so basically what it does is, in bucket 3, you have something that's going to beat inflation. Stocks are really the only thing that in the long run is guaranteed to beat inflation. So by having bucket 3, sorry, what is my Bible? Morningstar. It's a research website. Make sure for us Canadians to get the .ca version. They publish articles. A few of them they borrow from the American version, but they have Canadian specific articles. And if you search for bucket portfolio, you'll find multiple articles that they've written about it. So yeah, every morning I go there, and I there's usually 2 or 3 articles that they publish overnight that I read. So bucket three is what lets you avoid inflation risk in retirement, because in my example, that 9 million is what is really going to outperform inflation and keep your portfolio growing. Um, uh, Bucket one is what is going to prevent you from having to sell equities to live on after they went down, by having cash in bucket one and then the bonds in bucket two. And you're able to avoid sequence of returns risk. So sequence of returns risk, it's a complicated jargon. Basically, if if you get, especially after you retire, if you get a couple of bad years, your portfolio will not recover. So if you're all in stock and you get year one, you're down 10%, year two, you're down another 15%, year three, you're down 5%, your portfolio has now gone down so much that if the next 3, 4 years you're getting 20% returns, it will not recover, because keep in mind, if something goes down 50%, you need 100% in order to get back to where you were. That's how that works. So if at the beginning of to say it the other way, if at the beginning of your retirement you have a couple of good years, then you're set. Then you're set from there on. So the sequence is what's important, because if you have a couple of bad years and you have to withdraw money, if you're not working anymore and you have to withdraw money from a portfolio that's taken a beating, then that just kills it. I remember in 2008, 2009, at work, contractors, I saw some really old people there. I'm like, why are you still working? And like in 2008, their portfolio took a beating and they had to go back to work. So by having a bucket one and bucket two, you're able to avoid selling stuff that went down in bucket three, and you're going to give it a chance to recover. Okay, this is sort of to illustrate. I'm not trying to give you a strategy for retirement quite as much as I'm trying to illustrate how different assets perform, um, uh, just by their very nature. Okay. So how I would use it, you can either use it passively. I wouldn't recommend this, but you can get money only from bucket one, and then you shift money from bucket two into one, and then when bucket two has less than 8 years of spending, then you sell stuff in bucket three and you refill bucket two, sort of a waterfall kind of a thing. uh that's like, you can do better than that. This is very tax intensive, but what you should be able to do is actively decide, based on the previous performance of buckets two and three, which to pull the money from. So if the market was doing great, pull money from bucket three. If maybe the bucket three wasn't doing so well, then maybe use bucket two and bucket one to live on. So that's that kind of strategy. Yeah. So bucket one is safety, to help you avoid uh selling stuff that just went down. It is the 2 years is because you're retired. Otherwise, the 3 to 6 months is kind of the general guideline. And bucket three is so inflation doesn't eat away at your portfolio in a significant way. Okay, cool. So this is I know you guys can't, well, maybe you can. I'm close to it and I'm squinting. So this is Morningstar. I have a giant one on my wall. Unfortunately, it's even older than the 2017 that I was able to pull off the internet. By the way, that's Morningstar. That's the same research website. It's really cool. Everything from how the Canadian dollar was doing to the US dollar. See, it's the Canadian version, Canadian flag in the upper left. Who was in government, both in Canada and the US, and other interesting things. But what I want to point out here is the risk versus return, where risk is basically peaks and valleys, right? As we talked about. So you can see down here the green line, which is, hold on, I can tell you, it's Canada Treasury bills. So it's basically very safe. So they are averaging 5.3% a year, and you can see how. So by the way, on the left-hand side is 1950, and on the right-hand side is 2017. So this is showing 67 years. And you can see how the line flattens as interest rates sort of in the 90s and in the 2000s as interest rates went down. So you can see the green line flattening, right? But it's nice and smooth, but it's getting you 5.3% over those 67 years per year, just to be clear. The blue line up here, which did 14% over those 67 years, is US small stocks, small caps. You can see a lot of ups and downs, but over the long run, it outperforms everything. The next one, the light blue line, is US large caps. The red line, which came in third, is actually the Toronto Stock Exchange Index. So look at us go. So yeah, it's just basically getting the right portfolio for you. Obviously, you don't have to do all or nothing. You can mix and match. You can do that balanced portfolio I talked about as well. So, but this sort of illustrates that. So, what do we have? So, risk and return trade-off. I mentioned 1968 to 1974 is basically, I don't know if you can see my cursor, but kind of middle left is where you can see the dark blue line basically do next to nothing for 6 years, but go down. Or so if you were brave and you kept buying, you would have made out like a bandit after it recovered, and then it had a what, like a 15-year run up, but you would have had to have guts of steel. Term deposits, low risk, low reward, as I mentioned. And small caps are volatile, but they'll outperform in the long run. So if you have the okay, you guys can't see my cursor. Cool. So in the long run, small caps will do the best by the looks of it. Okay, so that's kind of the end of the third seminar. We're going to try to cover 5. What time is it? Okay, so well, yeah, we could finish at 8 Pacific if all goes well. So risk is volatility, but it's not necessarily bad, and you can take advantage of it if you have the stomach for it, that after the market's gone down that you will buy more. Risk is associated, correlated with returns. So you have to know yourself to know what investments you want to buy. Everybody is very happy and comfortable when stuff is going up. It's when there's a downturn, when you have to sort of pretend that like you have to pretend that there's going to be a downturn and invest appropriately. And I'll tell you in a little bit what I'm doing. That's doesn't mean that it's right for you. So know your risk tolerance, know your risk capacity, educate yourself, be aware of when you need the money, and know that longer term means you should be able to get into higher risk. But if you don't have the risk tolerance, if psychologically you're gonna not be able to sleep, then don't let the time frame override, your sense of well-being, I guess. And of course, what returns do you need? So those are kind of the five things that should drive what kind of investments are you buying. Okay. Okay. Seminar 4, asset types starting early and low fees. So I think I can go through this fairly quickly. Um, so we're going to talk about different asset types. I'm going to implore you to start early. Uh, the cliche is the best time to start investing was yesterday. The next best is today. So I don't care if you're 60 years old and you're worried about your retirement and you don't think you're going to have enough. Like, you have to start. It'll still be better than if you do nothing. If you're 20, congratulations, you can have a very easy life if you start investing and you do it on a continuous monthly basis. Be aware of fees. That has a bit of a caveat to it, which I will show you. Uh, Markets always go up in the long run, and long run is at least those 10 years, like I was mentioning before. Uh, in the short run, I could not tell you what the market is going to do tomorrow. I couldn't tell you what it's going to do next month. But in 10 years, I would be willing to bet a whole bunch that it's going to be higher. So asset types. So this is just kind of my own personal way of looking at the world. I'm going to contrast what I think is an investment, what I think is speculation, and what I think is outright gambling. You can hardly disagree. Uh, and obviously you have to do what you think is right for you. This is just one man's opinion. So to me, an investment is something that has a steady stream of income or cash flow. So I am a dividend investor. I like dividend paying stocks, uh, investments in real estate where you have a positive cash flow. So what I mean by positive cash flow, in session 3, we're going to talk about real estate. And so in Vancouver, for example, if you buy real estate, generally the rent is maybe going to pay the mortgage, but it's not going to pay the insurance. It's not going to pay for any incidentals. It's not going to pay the property taxes. And so you're having to kick in extra money. So that is not positive cash flow. That's negative cash flow. And you're depending entirely on increase in value, which is going to be the speculation, which is going to be the next one. Those of you who took any finance courses, I remember way back when at university, the value of an investment is determined by summing up the series of cash flows. So next year, the investment is going to bring me in this much, plus year 2, it's going to bring in this much, plus year 3, it's going to bring in that much. And those cash flows are discounted because they're out in the future, they're worth a little bit less than money today, right? Dollar tomorrow is worth less than a dollar today. So that's how I value my investments, with a stream of income or cash flows, or at least profits. But that's sort of where the gray area is for me with speculation. So this is where asset goes up in price because somebody else is willing to put a higher value on it. So to me, this would be stocks with no dividends, but they're making a profit. Therefore, you're getting price appreciation. They make a bigger profit every year, and therefore the share price goes up. So I would argue real estate with no positive cash flow but price appreciation is speculation. You're depending on somebody else putting a higher value on real estate. Uh, with real estate, that feels fairly safe and simple. But you tell me how much a piece of art is worth, right? Somebody says it's $50, somebody says it's 5 million. I couldn't I couldn't pick a Van Gogh out of a lineup. So to me, it's not worth very much. You see the problem? Same with collectibles. Bitcoin is the worst offender because it really has no intrinsic value. So that to me is total speculation. Gold is sort of the same thing. You can't eat it, you can't grow food on it, you can't build a house on it. It has a lot of history, which Bitcoin doesn't. Bitcoin just has, by the way, it's something I love to hate, so bear with me. Bitcoin just has a bit of a mystique about who founded it and this mysterious technology. Um, so to me, that's a total speculation where you basically need somebody to say, oh no, I think it's worth more than this today, so I'm going to buy it. And then as a result, it goes up in price. So value of a speculation is determined by what somebody's willing to pay for it. Talked about the art. Uh, how much is a Pokemon card actual utility? Other than starting a fire, like I don't really see it, but it is what it is. Um, I would include day trading, meaning day trading is when you buy a stock in the morning and you sell it in the afternoon. That's also speculation, and trying to time the market, I would argue, is speculation. Trying to guess what the market is gonna be doing in a month, like I said, is uh, you might have an opinion, but uh, you have not much of support for it. Um, And then the last one is gambling, where you have an asset which on the average is going to stay the same or maybe go down in value, but may go up. So to me, that's stocks of companies that don't make a profit and therefore they're not going to get any price appreciation. Real estate with no expected price appreciation, get rich quick schemes, that kind of thing. You could make money maybe if you're getting in on a ground floor, but not so much. So that's kind of how I see the world. I try to buy stuff that I consider an investment, which kicks off some sort of cash flow. And I do own stocks which are profitable, which, according to this, have drifted into speculation. Um, I definitely avoid some of the other asset classes. So that's kind of how I view the world. Obviously, form your own picture. That is totally up to you. Okay, importance of starting early. So this is just math calculations. A dollar invested for 40 years at 7% will turn into almost $15. If you invest that same dollar for 30 years, it's half that. Notice the number of years hadn't halved, but the returns have. So this is obviously just compounding, right? Compound interest, if you will. We're going to see the same thing. If you invested for 20 years, it's again half, and for 10 years, it's a little bit over a half. So I I tell anybody start investing as soon as you can. Um, so this is hopefully um, underlining that. Do note that initially you need to invest in yourself and get an education, so that way you can work or start a business. At the beginning, you're going to be trading time for money, but as you save and then you invest the money you earn, that money is going to start working for you. And you want it to work for you for as long as possible. So that's kind of how I look at it. Um, you can certainly become financially independent without going to college. Uh, I just think in general you get a higher level of income, but then again, you lost 4 years where you could have been earning money and it could have been appreciating. So it it depends what you're good at, you know. Um, Okay. Importance of low fees, kind of a similar calculation. If instead of 7%, you're getting 5%, that's going to have your returns just because of that 2%. This is just because you're losing out on a compounding of that 2%. You would think it would be proportional, but due to that 2% MER, management expense ratio we talked about earlier, uh, you lose more than half. It's not just losing a third or whatever you would think you would lose by losing the 2%. Do note, however, that when you look at a prospectus for a mutual fund, the returns are always after the fees and the MERS have come off. So this is where I say you should look for low fees, but if you can, look for stuff that has great performance rather than just a low MER. Because you can find mutual funds which will outperform their index, and therefore they will outperform the ETFs that follow that index. The statistics depend on what study you look at, but over a 10-year period, 70 to 80% of mutual funds underperform their index. So you can find that 20 or 30% of them that outperform. But if you don't want to do that, then just buy the ETFs with the low fees and you'll do all right. Okay. Markets go up in the long run. So this is the S&P 500 returns for the last 31 years. This might be slightly out of date. Red is losses. So losing up to 10% in a year happened 3 times. Gaining up to from 1 to 10% happened 6 times. Losing from 11 to 20% happened once, while the market made 11 to 20% 8 times. 21 to 30% loss happened once, while the market gained 6 times, 21 to 30%, et cetera, et cetera. So you will get the odd year of ugliness. We had one in 2022. 2023 was a lot better. I am not going to make any bets on 2024. I just know that in 10 years the market's going to be higher because of this chart, because of this diagram, because the average, the historical averages are with me. If there's a nuclear war or something, then obviously all bets are off. But assuming society survives in pretty much the same state, putting money into the stock market is the way to go. Deborah says, why are these Murphys not easier to see when taken off? This seems like they're hiding something. They do have to disclose the fees both on the prospectus. So like I look up my mutual funds on Morningstar, and right at the top it says what the MER is. Your brokerage, usually with your tax documents, will give you a document that says how much you paid in MERS. So they, yeah, I can see why it looks like they are hiding it. I kind of look at it that the mutual fund company needs to keep the lights on, wants to make a profit, wants to pay the research team and everybody. So like that's fine. But their mutual funds need to do well. They need to perform at least as well as their index, and preferably better. So yeah, I think they do disclose it a little bit better if you're looking at Royal Bank mutual funds and you look at the prospectus that Royal Bank puts out, it's probably a lot harder to find than it is on Morningstar. But yeah, that's why I'd rather own Royal Bank shares and be an owner rather than being their customer. because they make lots of money off of all of these products. So this is similar graph as previous 92 years. However, you can see that for 1 to 10% gain or loss, that were sort of balanced, but we started doing a lot better for 11 to 20% gain or loss. It looks like there was a year somewhere where you had a 60% return, which, not bad. So I'm just trying to convince you that the markets go up in the long run. They do. So historically, you're going to do well if you look at the history. Same thing here, more green than red. This is going back to the 1930s. You can see during the Great Depression, we had some tough years. But after that, you had the odd one. But here's 2008. Here's, I guess, is the dot-com crash. So like you can sort of pick them out. And yet another time, if we look at the red ones down here, thinking back to the bucket portfolio, and bucket one being 2 years of spending, you can see, other than the Great Depression, which the markets were in a bear market for 2.8 years. Otherwise, it's 6 months, 10 months, 11 months, 2.1 years, 4 months, 1.6, 2 years, 3 months, 2.1 years, 1.3 years. That's why you have 2 years of spending in that bucket one, is that you're able to not sell anything during a bear market. So this is the S&P 500 as well. So this is the US. Okay. So why do markets go up in the long run? People just wonder. So one is increasing population, whether it's birth rate, which in developed countries is actually pretty flat, or in Japan, I think their population is actually decreasing, and so China, because of the one-child policy, is as well. Immigration is fair game if your population is increasing because of that. That's when your companies have more customers, right? So that's why they make more profits, and that's why the share prices go up, and that's why the markets go up. Better technology and improved efficiency and productivity, leading to lower costs and higher profits. Again, in developed markets, you could argue that we've sort of squeezed as much efficiency and productivity by adding technology to our manufacturing and other processes. Maybe AI is going to be the next big run up in productivity. Developed markets have both an increasing and young population, going to the previous point, and they will benefit from better technology. This is my investing thesis. Please formulate your own. But I would argue in developing markets is where you can get a very hefty bang for your buck by adding even a little bit of technology and increasing productivity quite a bit. Inflation just on its own is going to create higher revenues. So Rhonda says, got to log off. I will put the recordings up on the YouTube channel. I'll see if I can email it to email the link to everybody as well. So yeah, I hope you can join on Thursday, same time. Hope it was useful. So yeah, inflation will also create higher revenues, and of course, higher revenues are going to create a higher GDP, so the economy keeps going up. Other things, sort of to add here, is don't be your own worst enemy. So you can see over the last 20 years, give or take, The S&P 500 returned 9.5% in green here, but the average investor got 3.6. So why does that happen? Well, people jump in and out of markets. They think they can time them. They think here's the market top, so I'm just gonna get out of everything and I'm gonna sit in cash because I really think that there's gonna be a 20% crash. So I will be able to take advantage of that and I will avoid losing the 20%. And the truth of the matter is we never get the timing right. Experts don't, and they have way more information than you and I do. Uh, so, somebody goes to cash and the market keeps grinding upwards for another year or two. And then there is a correction, let's say, or even a bear market. But then you look and you missed out on the gains for that year or two that you would have still come out ahead if you had just stayed invested. So it's a bit of a cliche, but it's time in the market, not timing the market. So yeah, try to avoid jumping in and out. Uh, I personally, and again, this is for me, not for everybody. As soon as I have money available, I put it into the market. I don't uh, I don't sit on cash, waiting and hoping that there's going to be a correction because you watch it go up and you're like, oh, I'm missing out on this. So then you jump back in, and then that's when 2 weeks later then it corrects. So like I'd rather spare myself that feeling stupid. So don't be your own worst enemy. Time moderates returns and volatility. So the first set here is if you have something for a year. So green is stocks. Blue is bonds, and then the gray is a 50-50 portfolio of stocks and bonds. So over 1 year, you can still see the averages to the upside. But with stocks especially, you can definitely have some negative years, single years. But now that you do a 5 year, uh, the downside is much less. And a balanced portfolio 50-50 doesn't have any downside at all. You'll notice it's also missing out on the upside, as I had mentioned earlier, that bonds are safer, but they are a drag on your portfolio. Uh, so you're possibly missing out on the upside, but also on the downside when you're in bonds or in balanced. Over a 10-year period, only stocks would ever be negative. And that was that one 10-year period, I guess. And over a 20-year period, there's no negative, and stocks will average, well, will be 6 to 17% per year, right? So this is again speaking to the longer Grant saying, where might the TSX fall in this chart? This is from 1950 to 2021. So this is over 70 years. So that's a good chunk of time. Like in the last 15, 20 years, the S&P 500 has outperformed the TSX. But prior to that, there were definite times when the TSX was better. Um, I mean, you would expect the same kind of trend. The numbers would obviously be a little bit different, but I would argue the higher your time frame is, the better off you are. So that's why if you can invest for the long run, you will get a better and safer return. That's that's kind of the point. So oh yeah, so over so I guess over 20 years, stocks are averaging 11.5, bonds 5.8, and then somewhere in between is the 50-50 portfolio. Okay, so that was chart 4. We talked about investments versus speculation versus gambling. I would suggest the former and selectively the the speculation. Start early and start often. Be aware of the fees, but make sure the net return is what you're looking for, and that's what matters. Markets go up in the long run, so don't be afraid to invest if you do have a long period. Okay, so some investing strategy. So this is the last seminar. I'm going to try to keep it. Well, let's see if we can finish this in the next 15 minutes. So we're going to talk about investing strategies. We're going to talk about lump sum versus dollar cost averaging and rebalancing, and some investment decision making, and what to do if markets go down, and my strategy for the stock market, just as an example. So investing strategy. So lump sum basically means you buy an asset. It could be a stock, it could be an ETF, it could be a mutual fund. You buy it a single time for quote unquote larger amount of money, whatever that means to you. So I feel better about paying, that $10 commission. I try to buy at least 5,000. Whoop. I try to buy at least, thanks, Deborah. I try to buy at least 5,000, preferably 10,000 at a time. So then that commission is just a tiny percentage. But basically one-time purchase. Dollar cost averaging is you're buying an asset monthly, quarterly, whatever it is, for the same amount of money each time. So if the asset has gone down in value from the previous time, you're buying more of it. So you're benefiting in future purchases from the price having gone down. Obviously, the rest of your portfolio also went down, so actually that's not great. But uh, we're all working on the assumption that the markets recover and go upwards. So by automating it and buying the same dollar amount on a monthly or quarterly basis, you're able to take advantage of a downturn. It it protects you against bear markets, or not so much protects, but it lets you take advantage of them for future purchases. Obviously, your past investments have gone down in purpose, have gone down as well. Um, Jimmy Frank says, "Is DCA on a daily basis a good thing?" Uh, I mean, that seems pretty frequent. I would assume you're doing it only if you're not paying some sort of a trading commission. Like if I'm doing $1,000 a month, I might do it into 3 different mutual funds or 3 different ETFs. And then even then, if I'm doing like 300, 300, 400, and I pay $10 for each of those trades, then I mean, that's a pretty hefty percentage. To do it on a daily basis, I definitely wouldn't want to be paying that commission. I'm assuming it would be no commission, and I'm assuming you would be automating it, because by the week's end I would be annoyed of having to go in each day and uh okay, and automate it. Uh yeah, see, the thing is, I also use a tracking software for my expenses and stocks and everything, Quicken. And so each time I do a transaction, I have to enter it in there. Your brokerage should track it for you. Uh, I wouldn't go out of my way to do it daily. I think monthly is fine. Uh, yeah, if there's no commission, fine. Uh, but I wouldn't think there would be a significant benefit to be doing it more frequently. So Deborah said, I don't mind the portfolio going down. It's fun to get a sale. Yeah, absolutely. As long as you don't need the money anytime soon. If you're going to start pulling money out and everything just went down, then you have to be in an accumulation phase in order to get that sale for sure. And in that case, it's fine. And then you just kind of close your eyes and you don't look at your overall portfolio, which obviously went down as well. And you're just saying, well, at least I'm getting a sale for this purchase. Okay, good questions, good comments. So the dollar cost averaging is typically used, I think, as we established in a pre-authorized payment, so the money is withdrawn automatically. The benefit, I guess, psychologically, is that you don't even miss it. Uh, there's people out there. I'm sure none of them on this seminar, but there's people out there who they basically spend every last dollar that they make. As long as there's money in their checking account, they spend. Okay. So for those people uh, who want to live their life that way, no judgment. It's not the way I want to live because I wanted to do that financial independence thing. But if that's not your thing, or you prefer to enjoy your life a little bit more, uh, then if you get something automated and you automatically have it after each paycheck, you get the money pulled out. So every 2 weeks, I guess, to Jimmy Frank's comment, maybe every 2 weeks, you just have it pull $500 from your checking account after your paycheck dropped in, and then you can spend whatever else is in there until your checking account is zero. Then if that's how you want to do it, you can. Uh, and you know that you can spend whatever's in there because you don't miss it because it was never out. The automating is important psychologically to a lot of people because every month, if they had to press a button, they they wouldn't. There would always be better things to spend the money on. Me personally, I have my TFSA with Wealthsimple. I put in $500 every month, and they don't invest it for me. They just transfer the money from my checking account into my TFSA, and every month I look forward to when the money is in there. It's like, okay, now I can buy my ETF. Uh, I don't think anybody else functions that way. So if you can do it automatically, uh, you you don't even consider that being your money, and you're saving for retirement. Uh, if you like, if you want to retire early and be financially independent when you're 30 or 40, you're probably going to have to take every spare dollar that you have and invest it along the way. So you will have to do something manually. Um, what I used when I was in my accumulation phase was I had a bunch of automated stuff come out. And then whenever I had that 5, 10 grand, I would buy a stock. So I just had to make sure there was money in my checking account for the automated stuff. And then whenever I got a paycheck, it's like, okay, we're gonna buy some Manulife this week, and this week we're gonna buy some Royal Bank, and so that went manually. But especially for people who are starting, dollar cost averaging, you fill out a form, you automate it, off you go. So rebalancing is it actually does help with the performance. So it is important to do it once a year, uh, every 6 months at the most. I read the study that basically said doing it any more frequently doesn't help. So here's what it is. Do it every 6 to 12 months, or when your portfolio mix of assets has moved significantly away from your risk profile. So what that means is, let me interpret, is you had a talk with your financial advisor or you had a talk with yourself and you said, listen, I think I'm pretty risk friendly, but not over the top. So I want to do 70% stock ETFs and then 30% bond ETFs. That's sort of where I feel comfortable. I realize the bonds are going to be a bit of a drag on the performance, but uh, I do want some safety. And so whatever cash you had, you put into a couple of ETFs, 70/30, and then every month, let's say you wanted to do $1,000, and every month you did 700 into the stock ETF and 300 into the bond ETF. And what you'll discover is purposely those two asset classes work differently on purpose. That's why we have them for diversification, right? So maybe the stocks had a bad year that year, and at the end of the year, your portfolio isn't 70/30 anymore, it's 60/40. The bonds did disproportionately better than the stocks. So your portfolio mix is now out of your risk profile. You're too conservative. You're too conservative at this point. So what you want to go back to your appropriate proportion in my example 70/30 by selling the asset that had a larger proportion of the portfolio than originally intended. So that would be selling the bonds in my example and buying those assets that now have a smaller proportion than you wanted. So I would sell 10% of I would get the bonds from 40% down to 30%. So I would sell like 20% of the bonds to lose the 10%, and I would use that money to buy the stock part of the portfolio, that ETF, in order to get me back to where I want to be. So in this case, I'm taking advantage of the pullback also in the portfolio, in the stocks, and I'm selling maybe something that didn't pull back as much. Uh, so let me just finish this and then I'll get to the question. So what this does is it sells high and buys low for the purposes of your portfolio. So it sold something that was disproportionately high and it bought something that was disproportionately low, and then it reestablished your risk profile. And it does have a couple of percentage points a year positive effect on your return. Um, Something that you might want to do is consider what account type um, you're investing in, because in a non-registered account, and we'll get into that next session, but in a non-registered account, if you sell something, there might be tax implications and fees possibly. So what you might want to do is, instead of selling something and then using that money to buy more, if you can come up with more money, then just buy until the right proportions are established. Okay, so let's see what the question was. So Grant says, question for another day: is there a decumulation formula for a portfolio of money? Example, 100,000 value of portfolio day, removing 5%. Today, removing 5%. The portfolio makes 5 to 8% a year. How many years will that portfolio produce 5,000? Yeah, so good question. So we're basically asking, how much money can we pull out of a portfolio? Uh, so I mean, if the portfolio is a dividend payer portfolio and it's paying 4.5%, plus there's some appreciation, you can sort of eyeball and say, well, I can definitely pull out 5%, no problem, because 4.5 is coming just from the dividends, and then there's going to be a little bit of appreciation for sure. There is something called the 4% rule. There was a study done in the 1990s where they figured out that if you have a stock in a bond portfolio, so balanced portfolio, uh, and let's say you retire at 60 and you pull out 4% of your initial portfolio and you pull out that amount every year, adjusted for inflation, you can do that for 35 years without running out of money pretty much all of the time. So like they just analyzed a bunch of 35-year chunks, and like 95% of them you didn't run out of money historically. So 4% rule is sort of a guideline. Um, Grant, you're saying in your question, if you know the portfolio makes 5 to 8% a year, you should be able to pull out that 5%. Um, if there is some variability, though, you need to consider if the portfolio has a negative year, going back to that bucket strategy, whether you want to be pulling money out of it, because obviously it didn't make 5%. So it really depends on the portfolio. But a 4% rule is a good general way to go. Yeah, Chris, if you're still on, have a good night, and I'll see you Thursday as well. We're almost done. I'll stay on as long as people have questions afterwards, but I want to finish session 5 here, or seminar 5. So investment decision making. This is just how to approach investing really of any kind. Warren Buffett sort of preaches being contrarian. This is what it's called. Be fearful when others are greedy, and greedy when others are fearful. So when you see a stock that is just skyrocketing and you're just like, it looks like you can make money at it, but like how long can this go on? Like I don't think the stock is actually worth this. Like uh, it's just going up on sentiment, just on blind belief. So that's the first part, is when others are greedy. That's when you should be fearful and you should be selling. Okay. On the flip side, when there's blood in the streets, hopefully not really, but just metaphorically, when everybody else is selling in a panic, uh, we saw that during COVID. Um, be greedy, and that's when you want to be buying. So, not to brag, but I actually borrowed to invest during the COVID crash, because I knew that either we were going to get a vaccine and the world is going to return largely to normal, uh, or we're going to have some sort of a Mad Max dystopian world where nobody was going to care that I borrowed $300,000 on my home equity line of credit, and um, we're all going to be fine. So obviously vaccine came out, and we were all fine. I paid back the loan, and everybody's happy, and I got a nice 25% discount on the stuff that I bought. Um, so that's basically the value of being contrarian. This is real easy to say, really hard to do. It requires a gut check. Um, to use another cliche, after the market's gone down, that's when you should be greedy. That's when you should be buying, because that's actually when the risk is the least. Uh, the cliche is you can't fall out of a basement window. Like it can go down a little bit more, but how much? But when everybody feels really good, when the market's been going up and up and up, people for some reason think that that's going to keep going forever, and it doesn't. And that's buying at the top of the market is actually when the risk is the greatest, right? But that's when everybody feels real comfortable. And it's really easy to put the money in then. Um, I again, I'm not suggesting to time the market. I'm just telling you to be aware that being contrarian is the way to go. I'll give you my investing thesis in a second. So sell when expensive, when people are greedy. If you are looking at your portfolio and making those kinds of decisions, buy when it's cheap. Again, what defines cheap? Where's the bottom of the market? That's the difficult part. Make your own choices to try to outperform the market and all the experts. We all try it. We all think we're the chosen ones. Uh, we all think we're special and we're going to be able to time it perfectly. And I don't even try. I don't even try anymore. Um, I just like I said, when I have the money, I buy. Um, so have an investment thesis and compare your portfolio to this thesis. So I do, and I'll show it to you as an example in a second. Don't buy hot stock tips. My God, when somebody talks to you at the water cooler or in the kitchen at work, it's like, oh, I made so much money. All right, Grant, see you on Thursday. Thanks for coming. When somebody at the water fountains, oh, I made so much money on the stock. If you feel jealous and you feel, the whole FOMO, fear of missing out, if somebody's money quadrupled, sure, it could go up some more, but it's likely that you're going to be left holding the bag and you're just going to lose money if you jump in at the end. You don't know where that end is, where the top is, but what you want is somebody who says, my stock got smoked, but I still believe in it. That's the stuff you want. If somebody's telling you that they quadrupled their money, then they're just bragging. They're not trying to give you a stock tip. Okay. We talked about day trading earlier. This is a statistical fact. They actually have to disclose it during seminars about day trading, which I found sort of odd. But 90% of day traders who buy and sell the same stock in the same day lose money in the long run. And I said earlier that they're speculators rather than investors. Okay, so what to do when markets go down? What do we do when markets go down? Um, Selling is the worst thing to do because the market's already dropped by the time you sell. So you're probably selling near the bottom. For me, it would also throw my portfolio into disarray since you can't really plan and you can't do it in sort of an orderly fashion. Um, so I I just buy. ABB, always be buying. Um, like only if I totally lose faith in some stock is when I would sell it. I wouldn't sell it at the bottom of some sort of a panic selling roller coaster. So that's generally the worst thing to do. What most financial advisors will talk you into is to do nothing. Uh, Market's going to come back. I would I would speculate in my conspiracy theorist way is that the financial advisor just doesn't want to fill out forms, so they just tell you, yeah, just do nothing. But it's a good idea compared to selling. The best idea is to buy more when prices are low. Uh, they will go back up on an individual stock, maybe not, but on something diversified, like on a mutual fund or an ETF, it will come back eventually. So when it's down, stuff is on sale, so buy more. Um, this is really easy to say, hard to do. Like when a Canadian big bank goes down in price, I'm so happy to buy it because it's on sale and I know it's going to come back because I cannot imagine what would happen or be happening in a Canadian economy if the bank got into serious trouble or went bankrupt. Like it would just be chaos. So I know that's not going to happen. So here's a really interesting quote, which uh, anyways, you make most of your money in a bear market. You just don't realize it at the time. That's when you make money, when the stock is low or the mutual fund is low or the ETF is low. You don't make money by investing when it's had a long run up. That's, like I said, is the highest point of risk. So my strategy for the stock market, this is what I do. Maybe this will sort of bring it all together, and I think we're going to call it uh, a day. So I realize that I am unable to time the market even reasonably, let alone perfectly. I will not be able to find a bottom to buy nor a top to sell. You have to be right twice, once to sell and then second time to get back in. The market could just give you a head fake about what it's doing and then do something else. So I stay invested at all times. I put spare cash into the market because the market goes up in the long run. So I know in 5, definitely 10 years, I'm still going to be up. I do keep a small amount of cash as an emergency fund, but I don't really keep 6 months worth or anything. If there's a drop of more than 20% in the overall market, I buy more however I can as an extraordinary purchase. So this is the whole be greedy when others are fearful, because the market is on sale. It could go down more, but it's impossible to know where the bottom is. So I am satisfied with a 20% discount when the market comes back up. One way to buy more is to borrow to invest, but please, please, please be careful about borrowing to invest. It adds risk and it will cause both gains and losses to be multiplied. So I would, I'm risk friendly and I'm okay borrowing to invest. As I had said earlier, I've done it a few times now, but I wouldn't recommend it for the faint of heart. And that's the way that you don't have to have cash ready for an investment. That's when you borrow when after the fact. It's really hard to be proactive about timing the market and getting out and being in cash because of the timing, but it is possible to do it after the fact reactively because I know the market's gone down. So now here I'm going to have to start paying interest on the cash that I'm going to invest. So having that opportunities cash is the other way to go. That's not what I'm doing. I personally want to stay fully invested. Obviously, make your own decision as far as how you want to organize things. And that's it. So we talked about investing strategies, lump sum, putting in a big amount all at once, putting in a little bit every month and rebalancing, and then being contrarian. And finally, what to do if markets go down, buy more when markets go down because they're on sale. And my strategy for the stock market, and again, borrowing to invest is not what I would recommend for everybody.